Hello everyone, and thanks for joining me in Fundamental Signals. Today I'm going to show you why UNH is still a good opportunity. Alright, first let's take a look at the revenue. This is a chart of the revenue and the chart of the price of UNH. And visually we can see this beautiful correlation between the price and the revenue since 1986. Okay. Recently, we saw this correlation broke down. So that happened at the beginning of 2025, and price start going down, where revenue was still up. Nothing happened really to the revenue. April 2025, and then from there we went from $500, $600 per share all the way down to $237. And recently we have had this rally bouncing here from 363 down to 270 and again up to 366. Now the question is it still a good opportunity? And I think the answer is yes, it is. And why am I saying this? First, take a look at the correlation between EPS and revenue with price, right? So we see this perfect correlation over the history of the stock as 0.963. And recently, this correlation, especially for EPS, broken down. Right now, last year, the correlation been 0.293. Now, what does that mean? Well, that means what we see here. It means stock is lagging behind. Stock price is lagging behind the revenue. Revenue is growing. Revenue is doing good. The price is not doing good. And when you have this gap, it usually closes because in long term, we have this perfect correlation, right? So we can expect this gap to close in the near future, in the midterm future. Beside that, I'm also going to show you P2S ratio. UNH P2S ratio versus a 2-year average P2S historically has been a great indicator of when the price, the stock is undervalued. When is a good buy, basically. So we can check this out visually, right? So this time that it's in the green zone, meaning the P2S ratio being lower than 2-year average, we can see that it corresponded to these lower prices. But as soon as the P2S ratio goes back up, that's when your rally starts here. You're rallying basically in this case from 12 cents up to 36 cents. Okay. Again, here's a dip. Here's a rally up. Dip, rally up. Dip, rally up. A dip in the price here, rally up. Now, sometimes these rallies are not as magnificent as we want to be, but there are rallies. Another one, dip here, and again go up. And dip, and this rally continue like forever. I mean, here and there we have these dips that it gives us like brief signals, but recently we have had this massive dip in the price. So, and that corresponded obviously to this P2S ratio being lower than average. And recently, with the recent price action in the last couple of weeks, this indicator went up from -1 to -0.75. Okay. Now, what does that mean for us? Let's take a look at the history and what happened before, so we can make an informed decision or informed prediction of what might happen in the future. All right. So let's take a take a look at this crossover strategy. Okay, so right now we are crossing up from below -1. We're crossing up from this indicator, and let's say we want to exit this position, this trade, when the cross goes above 0. So you enter at -1 going up and you exit at 0. We run this back test and come down here and see what happened. This setup happened 94 times in the stock history. On average, you would have the return of you would have been 15%. Only 5% of this 94 times you would lose money. 95% of the time you would gain. Now, 4% of times your gain would be 0 to 5%. 44% of the time it would be 5 to 15%. And 45% of the times it would be above 15%. And these on average would come to 15%. Okay. Let's say you waited a little bit more. Oh, sorry, something I forgot to mention. The average days that you would have waited for this setup to finish and you get into the trade and exit would have been 199 days. Now, what if you waited a little bit more for this indicator to go above 1, for the stock to basically become overvalued based on this indicator? Then in that case, your average return would go up to 29%. But the average days that you had to wait for it to happen is now 395 days. So a bit more than a year, but then your average return would go up. All right. This setup happened 88 times in the stock history. Okay. So we have good data. So the good thing about these stocks that have have been traded for a long time is that you have a lot of data, so you can see what happened before. And last thing I want to show you is the P/E ratio. So same thing for the P/E ratio. We can check P/E ratio versus the 2-year average. And again, the green shows the dip, red shows overvaluation. So right now, like recently, let me zoom in, we crossed above 0. We crossed above 0. We're sitting at 0.24. Now let's see what happened if we enter a trade when it's crossing above 0. So now, because now it's 0.24, let's actually be more accurate. Yesterday it was went from, okay, let's go, we're going above 0.2, right? Recently been above 0.2. Let's say we're waiting up until it crosses above 1. On average, you would have made 18.55% on your trade if you did that trade. 137 times it happened before. 3%. So basically 7% of the times of this 137 times you would have lose money, but the rest you would have gained. And the gain was 14% of the time. You could expect between 0 and 5%. 36% of the time you would expect 5 to 15%, and 43% of the time you could expect above 15% return. All right, so chances are you're going to make money. Now 43% of those times would be above 15%, and on average around 19% return. Okay, your wait time would be 174 days. So overall, I think UNH still a good buy, still a lot of room to grow. You can expect, I don't know, 20, anything between 15 to 30%, I would say, in the next 150 to 300 days. 150 to 300 days, you can expect, 15 to 30%. I think it's a decent trade. It's a decent gain. And UNH is actually a very solid stock to buy and hold. Hope you like this content. Please subscribe. Please give me a thumbs up, and I'll see you next time.